Welcome to the Bear Trap podcast. It's almost 7 on Monday over here, so market's going to open in a few hours. I just wanted to do a podcast on term structure, and we're going to try and keep it relatively simple, although this is kind of a complicated topic. And for this particular episode, I'm just going to stick to what it is. So we're not necessarily going to get into how to trade it, what it means to trade it, because it is a little bit tricky to trade. It means that you're starting to trade volatility, right? You're trading time, in other words, which is a very different thing to be trading than just direction, which is what most people are used to trading. And I would even put it this way. I think if you're trading the term structure, you're trading the expansion and contraction of time in different portions of the time scale, so to speak. And I'll explain what I mean by that in a little bit. But the main place I wanted to start, just to convey how maybe complicated some of this stuff is this SPX options surface, which I have here on the right. And actually, let me zoom in a little bit, which is kind of cool. I can zoom in on both at the same time. But just so that we all are looking at the same thing, right? These are the strike prices that you're used to seeing on your options table. 3,600, 3,800. The way that AUK has it set up, it's pretty broad. And then these are expirations over here, right? So we have our, I don't know what we would call this. I guess this is our x-axis here. Our y-axis is actually volatility at the mid, which we've talked about before. It's basically taking the mid price of an option, right, between the bid and the ask, and then using the Black-Scholes formula to calculate the implied volatility, which would essentially, the easiest way to think about that is the move that's implied, right, by the price of that option. Then these are the days to expiration. So this is your time axis over here. And so you can see actually that there are some traits to the surface, right? It's not just flat, meaning that basically if you go out of the money to buy put protection, these 3,600s, these 3,800s, you actually have to pay a little more, right? Or a lot more actually than if you're buying, let's say, at the money options all the way over here around 4,600. And this, it's kind of neatly coded over here. So these are, I'm pretty sure, yeah, these are the implied volatilities right here. So if you think about it, right, like currently in 0 DTE, and the surface doesn't quite extend all the way there, but I just know where we're at because I've been looking at these charts. 0 DTE, SPX is trading around at 8 vol, right? So just from the 12, this yellow region, it's going to go all the way to like an 8. Let's see where my mouse would theoretically be. Let me get a little bit. Let me see if I can draw a little bit. So it's like basically imagining if we were to come down here on the surface and then draw a point like right there, right, which would be coming up from 0 DTE, and then it would just kind of be like over there. So that's like, I don't know, 8. Also, sorry about the terrible handwriting, but using a mouse to do this, eventually I'll figure out something better. Yeah, in any case, it's relatively, how would I say? It is hard to get actionable tradable information from the volatility surface unless you really know what you're doing. But what is really cool is just to understand that the entire options complex is being displayed in one place. So we can see everything that we need to know. We see strike, we see time, and we see price, right? Which is what's so beautiful about this type of chart. So the easiest way to understand both skew, right, and I've made a video about skew, and term structure, and actually this guy's on the wrong tab over here. I gotta pop this over. The easiest way to understand them each is that they're each breaking down the surface along a specific dimension. So I'll start with a skew because that's what we're more familiar with, at least in Bear Trap for right now. So you can see that the skew is literally just taking this, like we're taking, actually, let me draw on this one, this y-axis, volatility at the mid, and the x-axis. And that's what we're drawing, right? Like literally so we have volatility here, right? And then if we look over here on the skew, we also have the same x-axis right here. And then strike price along the bottom. And in this particular case, we are looking at multiple expirations, except that those expirations are color-coded, right? Like according to the legend. And what can be a little difficult about this is just distinguishing between the colors, to be honest, because sometimes we see this sort of cluster of red down here and we're aware, bull market and all that, shorter dated options, and we're going to get into why this is the case, have a lower implied volatility than the longer dated stuff. But the point is that these are all little red lines that are kind of hard to distinguish between each other. So I can tell you, yeah, this is probably 0 DTE, that's probably 1 DTE. But then as soon as we get it over here, I'm like, I don't really know what's going on. It's just kind of a mess, right? But the point is that if we just took this y-axis, this x-axis, and then plotted it on one chart and just took for DTEs, color-coded them, we're essentially just smushing the volatility surface along 2 dimensions. And that's what our skew chart is. It's relatively simple in terms of that conversion. And there's certain aspects that you guys will notice in the smile or in the skew video I talked about a lot. And one of those has to do with the distance between these guys, right? So you can tell that, it's very important actually that the 0 DTE is all the way down here trading at like an 8 vol. And then this guy here is around, on average, it's a 10, right? So there's that difference, right? And the fact that, and that difference is going to affect the overall behavior of the market over time. This is where we start to get a little bit further into the tradable information category, because if we know what the expectation of future volatility is, and we know the difference between the volatility implied for today, the volatility implied by tomorrow, we can start to see sort of where the juice is, so to speak, right? Where are people placing their bets? Because as I also covered in the last video, volatility is just another way. It's a jack of all trades, so to speak, right? Because on the one hand, right, volatility is, as I've been talking about, it is a way to talk about the move that is being expected, right? It's not necessarily directional. In fact, it's not, right? It's just, it's directionally ambivalent, but it is the extent of movement that we could expect. And a lot of us are really familiar with that. But it's also the reason that we can even calculate volatility is because people are willing to pay a certain price for a certain option. And so taking all the other Greeks, taking Black-Scholes, it sort of will pump out this number, which will give us that expectation. So the reality is that you can think about price in terms of volatility, or you can think about volatility in terms of price, right? And I'm talking about option price here. And then to make that connection a little bit further, option price itself is going to be derived from people making transactions like any price. So if people are bidding, right, if there are more buyers than sellers, then the option price is going to go up, which means that the volatility is going to go up, which means that the expectation of a movement in that underlying, with some constraints regarding strike and expiration and whatnot, expectation of movement in that underlying is also going to go up. So these are all sort of facets of the same thing, and learning to convert between those two and those three, I'd say, in your head is actually really useful for understanding all of these different shapes and charts and so forth. But okay, so we've covered in a really rudimentary way, okay, if we slice the vol surface, how would I put it, along the z-axis, then we can get this skew chart, right? But what happens if we slice it along the, actually, did I do that correctly? Along the z-axis? Yeah, we're taking slices, yeah, exactly. What happens if we slice it differently? So in this particular case, all we're doing is we are looking at so imagine if you could rotate this cube, right? Now we've suddenly made this guy, DTE, is our x-axis, and we're maintaining volatility at the mid as our y-axis, right, for term structure, x, y. And you can see how the yellow here, which are the shorter term expiries, which I said was over here, I said it was around an 8, right, in terms of vol. That's exactly where we are, right? That is our shortest 0 DTE expiry. And then as we move our way along the term structure, which is moving our way along the volatility surface, we can see that vols creep up. So essentially what we're doing is let me draw a little arrow here, we are moving in this direction, right? That's all we're doing. And then the question is, okay, well, what do we want to use for, because there's a ton of different strikes, right? So where are we going to take our slice if we're going to do that? Because we're only really looking at one curve. What Ock has done here is he's taken multiple slices, and this is sort of typical practice for term structure. So if you were to imagine that this is our x-axis here, that's our y-axis. Man, that is a terrible y. Let me improve that by squiggling over it. There we go, perfect. Now you guys can totally make out that that's a y. Okay. So let's say that this is one line, right? And this is occurring at the, I don't know, I guess we could say this is the 4,400 strike, right? And then let's say that we take another slice over here and we go this way up here. Let me do, 4,400. And then, whatever, let's say this is 4,200, something like that, right? And so you can imagine that what we're actually seeing over here are those slices where we are proceeding along the time dimension, observing volatility, and each time we're looking at a curve, we're taking a curve along a pre-specified route here. One little hiccup here, right, is that I want to address, and this is something that I think is really easily missed. Maybe not super relevant for trading, but very interesting and important to understand. Well, it's interesting the drawings move. In any case, is that I'm saying that we're taking a slice along a pre-specified strike, but that's not actually 100% accurate. The reality is that we're taking slices along a pre-specified delta. So for the 50 delta call and the 50 delta put, which are both at the money, it is the case that we're taking a slice at a pre-specified strike. But the reality is that as you go further out in time, the 25 delta call, for instance, is also going to move out, right? And that should be intuitive because how would I explain this? If let's say that I'm buying a 0 DTE call, so we're buying one that's all the way over here, then maybe the 25 delta is going to be, I don't know, 10 points out of the money on SPX. But if I'm buying a 25 delta call for tomorrow, then it should be probably 12 points out of the money because we have a larger expected move for tomorrow. So I'll get a similar behavior in terms of the price of my option, even if it's further out, because there's a larger expected move. So essentially something that the term structure is doing, which is kind of hard to do on the surface, is that it is standardizing for delta, right? So when I'm looking at a 25 delta call or a 25 delta put, I know that regardless of the fact that those are happening at different strikes for different expiries. So in this particular case, and this is directly related, by the way, to the implied vol, right? If you have a larger implied vol, then that's actually going to push your 25 delta out a little bit more. But again, this is more a subtlety than anything else, but it is kind of cool. So to just use a concrete example, let's say that I'm looking at September 5th, which is right here, and this is a 25 delta put is trading up here at like 15 vol, something like that, and then I'm jumping out to September 29th. That 25 delta put is going to be further out of the money in pure percentage terms than the 25 delta put over here, but it's still going to be a 25 delta because the Greeks are a measure of how option price is going to behave. So it's standardizing for implied volatility, it's standardizing for time, all those good things. But talking about this kind of brings something else up, which is, okay, that's interesting. If the deltas are moving as we're going across the vol surface, we're not just plotting it against strike. We kind of have this issue of, well, what if I do want to look at, a relatively consistent measure, right? Consistent distance from strike. And that's why we have these moneyness plots over here. So Moneyness is just a measure of whether something's in the money or out of the money. And the really quick and dirty way to think about it in this particular case is 100 moneyness means that something's at the money, right? And this is irrespective of put or call. So it's actually combined put and call together. 110 moneyness means something is 1% in the money, and 90 moneyness means that something is 1% out of the money. It's really that simple. The trick to it, though, is that we're no longer looking at put and call separately, so you kind of have to reimagine what you're looking at. It's sort of a way of comparing in the money, at the money, and out of the money volatility, irrespective of option type. What should we be using this for? To be honest, as of right now, I'm not totally sure. I don't use it a ton, but I think because it's on the chart, and because it's a different way to think about this, you guys should at least be aware that it's there. But I'm not going to go into it too much because it is a little bit of a mess. So something else though that I wanted to get into, and that Ak mentioned when I was talking to him about doing this video, and I think it's a really great point, is these red lines right here, in particular on SPX, it's what we're calling the VIX window. So the VIX is calculated using the prices of out-of-the-money SPX options. So for those of you that aren't aware, even though the VIX is its separate instrument, and you can buy options on the VIX, technically the VIX is a derivative of derivatives. So it is calculated using and I think it is the 25 delta. It is the implied volatility of the 25 delta puts and 25 delta calls from the SPX within this particular expiration range, which I think is somewhere between 20 and 30 days. So whenever you do pull up the term structure charts on SPX, what's really nice is you can see, okay, what is being used to calculate the VIX right now? And for those of you who trade the VIX, and I do that sometimes. I don't think it's a ton of people in Bear Trap, but for those of you who do trade the VIX, if you want to get a sense for what it's going to do, how it's going to behave, then you probably should be looking at this. And you probably also need an understanding of term structure in general, right? Which is what we're getting to once we're done with this whole portion on the charts. So now that we've just kind of got our basics down in terms of just reading the charts, I wanted to run through a couple of different examples just so that we can get a sense of how term structure can look, because this is a very classic case of term structure, and it's what's called Contango. The terminology doesn't really matter. The point is just that further out expiries are more expensive in volatility term than near dated expiries. And the reason for that is it's not too crazy. I mean, there's a few different reasons for that. Most fundamentally, and this has to do with the fact that, like I was talking about, right, like volatility has those three phases. But the most basic reason for that is because people are willing to pay more for longer dated options, which makes sense. If I have an option and I'm going to have that option for more time, I'd be more than happy to pay more for it because it's a longer term asset, so to speak. It's longer term optionality. But from a purely statistical point of view, the reason that longer dated options are more expensive is because more can happen before they expire. So if you were to, for instance, get a jump in vol anywhere in this time, like anywhere before the 15th, that would elevate or be more likely to elevate vols across the term structure, which would give your options a boost. So the further out you're buying, usually you have to pay up a little bit more. Although the dynamics there are actually quite interesting and complicated because vol is mean reverting, right? So let's say that you have bought an October 31st option. Let me pull up the little drawing thing too, so I feel like that makes this a little easier. So let's say that you've bought an option over here. Let's say that you actually bought the at the money, right? You got this guy over here. So, and then all of a sudden, I don't know, tomorrow, let's say that, man. The examples that come to mind are always somebody nuking somebody. But let's say that we get a surprise interest rate hike for no particular reason because, Jerome Powell ate some bad cereal for breakfast and got food poisoning. I don't know, and went a little nuts. So in that case, we're going to probably see these vols over here jump like crazy. They're going to come up, right? And I'm talking about volatility irrespective of put or call, right? Everything's going to jump because all of a sudden we're going to move from a place of complacency to a place of intense excitement. So when that happens, we're going to actually move and things are going to look a little bit more like this, right? And keep in mind, right, when we're moving from this image on the left and this image on the right, in terms of term structure, sorry about that, everything is being elevated. So it might look like, okay, the far dated expiries are lower, but pay attention to the axes, right? And these actual numbers. Let's say we're jumping. I mean, this is a crazy scenario, right? This is AMAT. We just picked it because it has earnings soon. And so there's a lot of implied volatility being priced soon. And then there's not as much in the back. That's why we're using it, but it's a good example here because like I was saying, we can move from a situation if we have a volatility spike. And incidentally, COVID was like this. When we had the COVID sell-off, things were like this, although they were also slightly different, which I'm going to get into in a little bit. But if we have a spike in volatility, it's very, very likely that all volatilities are going to be elevated, and all of a sudden demand for shorter term options is going to grow a lot, even relative to longer dated options, because people want protection now, right? Which is what you're seeing here. People are preparing, in this case, for earnings in AMAT. And so, oh man, it looks like I had some drawings there already. People are preparing for earnings in AMAT, and so they're like bidding up all these options over here, but nobody's really that interested in the options back here. Or, I mean, there's a lot of interest, but not as much, right? So we could see something like that start to happen. But the problem is, going back to our original trade example here, if something like this happens, notice that these vols could get bid up, but if you're in a really far dated expiry, that might not change anything for you, or it might not change very much. So you could have a massive sell-off, and if you're hedged too far out in the term structure, you might not receive as much of a benefit from it as if you're hedged closer in the term structure. Because the fundamental principle here, as with everything markets, is always you want to own the thing that people are going to end up wanting, and then you can sell it to them when they want it, right? So if you own this thing that's really far out in the term structure, but people want protection right now because we all of a sudden have this, then your asset may have appreciated a little bit because let's say the whole structure was lifted because volatility expanded across the structure, but relative to how much the shorter dated options lifted, maybe your guy didn't lift that much. So that's something to watch for, right? You're always trying to think about the relationship between the volatility in these different expiries and how expanding volatility in one expiry ends up impacting the other ones. And that's why we talk about, this as contango, this is technically over here backwardation, because it's backwards from what we usually see is the way that I think about it. And it just means that there's a lot of shorter term demand for options and it peters off. And so just to address something, right, earlier I was talking about how options in a normal world, so to speak, as you go out in the term structure, have a tendency to be more expensive in volatility terms because more things could happen. But AMAT is a case where we know when something is going to happen. So our expectation is there's going to be a lot of volatility around earnings, which is around August 18th. And then after that happens, things like AMAT's probably going to oscillate a lot, and then the volatility or the excitement is going to die down. Which means that, let's say that if you're holding one of these longer term options, by the time that option expires, you're going to have gone through a period of really high volatility and then another period of really low volatility. And so these further dated options are priced not exactly mathematically, but roughly as the average volatility that is going to transpire in the period until they expire, right? So actually, let me hop over to NVIDIA here for a second. Can't let you guys get too comfortable with one chart. So NVIDIA also incidentally has earnings, and I'm pretty sure they're around here, right? So this option is pricing in the average volatility, so to speak. And when I say average, again, technically it's not exactly the average, but I'm just going to use that as a shorthand here so that we have a common idea of what we're talking about. So this guy over here, right, is priced as the average volatility that's going to transpire until it expires. Sorry, and then this guy is as well, which means that our expectation here, or the market's expectation, is we're going to get a lot of volatility here, and then from this expiration, from August 25th, from this period on the 25th to the 1st, let's say that our volatility is actually going to be something like down here, right? So if we had to draw out, let me get rid of some of this stuff. If we had to draw out what we think is going to happen, we're going to say that average volatility until this point is going to be all the way up here somewhere. And then as soon as that's over, average volatility is going to be all the way down here. So that over the lifetime of this specific option, it is fair for it to be priced at whatever it's priced at, let's say, 67, right? Because this guy's up at 70, 77, and this guy is down at, okay, I didn't really draw it there, but let's say that it's, drawn at, 57 or something, right? And this guy's right around the middle. So you can really read the term structure to get a sense for where things are going to go nuts and where they're going to calm down. But this is, kind of relevant when it comes to NVIDIA in particular, is, hey, like this thing doesn't seem like it's going to calm down a whole lot. Let's get rid of that. Bye-bye. Why does it keep doing that? It doesn't seem like it's going to calm down a whole lot. And what I mean by that is, if we look at AMAT, right, it's pretty clear. Like, look at this shape. Look at how much it's going to calm down, and then eventually it's going to come back. Let's zoom out just a little bit so we can see it. It's going to come back to an average volatility down here of around 38%, it looks like, which, hey, surprise, surprise, is in line with IV90, which is the 90-day, historical average. NVIDIA also seems like it's going to come down to IV90, right, eventually, which also makes a lot of sense. But what I would say is that the structure here, I don't know, this is more of a subjective thing, but to me it seems like it doesn't taper off as much and like it's remaining quite elevated. So I'm not totally sure what, because NVIDIA's also been going crazy, right? So when we're talking about IV90, that's also influenced by the meme-ness of NVIDIA lately, which means that it's probably quite elevated because it moved so crazy that even the bidding on the calls was enough to bring vols up in NVIDIA, which is something that you'll see with meme stocks. Usually it's only something that you see when things sell off. But NVIDIA is an interesting example because it's been selling off into earnings, and now it's going to have earnings, which is going to further expand volatility. And then, yes, volatility is going to compress, but man, I wouldn't be surprised if it can continue to expand if we get continued downside in it. So this would be a case where, actually, I mean, it's kind of an interesting comparison to look at different stocks and see, how quickly are they supposed to come back to their IV30. So with AMAT, for instance, right, we're going to have earnings on the 18th, and then it's going to take until the 8th for it to come back down. So that's 1, 2, 3 expirations. With NVIDIA, it looks like the idea here is it's actually quite similar, which is interesting. It looks like it's going to have earnings on the 25th, and then it's actually going to come back down to IV30 really quickly, relatively speaking, because again, it's having earnings later, so it's only 2 jumps. So, just another thing that you can observe here. One more concept I wanted to cover before we finish up this video, because I know it's already been kind of long. And that is that it makes a lot of sense to try to pay attention to the distribution here in the sense of, for instance, if we stick with SPX, something that I do look at sometimes, not a lot, but sometimes is, hey, is the at-the-money call trading above the at-the-money put, or the at-the-money put trading above the at-the-money call, right? And that discrepancy. And this is something that I think Mentor-Q has been bringing up a lot, so it's not, it's not going to blow anybody out of the water, but it's just good to know, because if you see some discrepancy, meaning that there's a big distance, then that does actually really mean something. Usually they should be together, and the put should be a little bit above the call, because put protection has a tendency to be priced above calls, because there's more call sellers, more put buyers, insurance, and all that. Another thing that you can pay attention to is just this distance here, right? How far do we have to go until we hit the 25 delta call? How far up do we have to go in vol terms until we hit that 25 delta put? And it's essentially another way of trying to see, are we skewed one way or the other? And it is quite a reasonable translation. Let me put the term structure back up here so that we can actually compare. Your skew is going to determine how skewed you are, is going to determine these relative distances, right? So currently we're in put skew, meaning that puts are more expensive than calls, which is why this distance to the 25 delta put is larger than the distance to the 25 delta call. So for now, I think I would just propose this as, and term structure has been super common for a really long time, right? Like you can look at term structure and bond yields. I think the real origin or main use of term structure is in futures pricing, because as futures roll, they can trade at a premium to spot price, but then eventually they have to coalesce. And so when we're looking at implied volatility term structure for options, index options, equity options, it's sort of, man, I actually don't think about it as the most natural place for term structure, even though it applies just as well as in those other cases. But just to mention, there's a lot of other term structures out there. You can term structure almost anything. But yeah, going back to the topic of the skew, the fact that this distance, that there's an asymmetry here, is reflective of the fact that we have put skew. And so you can also compare, okay, well, is the skewedness expanding over time or contracting over time, et cetera. And I'll get into in a later video why that might be relevant. But more broadly, I think the main takeaway, aside from just being able to read the charts, is understanding whether we are in this contango type of situation, whether we're in backwardation, where vol is being priced high versus where it's being priced low, and this idea of, I didn't call them this, but forward volatilities. In other words, the difference between these junctions, right? So it's another way of thinking about how much volatility is being priced not only until a certain date, but between this date and the next date, right? And remember, it vaguely works like an average. So if as with the example I had here, right, if we're going to be trading at this type of vol here on average, and then our average is going to come down here, this particular option further down the road includes everything that happened prior to it. So your average vol after the event should actually be somewhere down there. So yeah, those are the main concepts that I think it makes sense to get across for now. And we'll do more videos down the line as we sort of get into it. And if people don't hate the vol surface, then I'd love to make more videos about that, because they're really fun, especially if we get to sort of animated vol surfaces, stuff like that. Yeah, anyway, thank you guys for listening. Like and subscribe if you haven't already. If you guys have confusions, questions, concerns, let me know in the comments. Let me know on the Discord, whatever the case may be. Hopefully this is helpful and not too confusing. We're doing our best over here with some tricky stuff. So yeah, I'll see you in the next one.